Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. This is an episode that's near and dear to my heart because this is my area of expertise. Today, we're going to be talking about autumn tax planning for financial advisors. So for those of you who are listening to this and not seeing this on YouTube or, on another video platform, I'm going to recommend that I'm going to try to speak to you. There's a lot of technical stuff going on here. And so in the materials for the podcast, we're going to have the actual slide deck that I'm using for this. And if you do find that you want to watch this instead of listening to it, because sometimes when it's this technical, it can be hard to just listen to, there's going to be a link as well to the video format version of this nearby for you to be able to engage with that. So let's just jump right into it. This is my autumn tax planning for financial advisors. So my main points for today, I'm going to walk you through the actual cadence of what I use for the firms that work with us. So the first step is know what you owe. Step 2 is where do you want to go? These are a bit cute. I'll explain what I mean by this. Third step, we look at cashless planning techniques. Fourth step, we look at strategic cash moves for tax management. And then bonus, we're going to look at 2025 tax law changes. Maybe that's going to be if you're listening to this before bedtime, that's the falling asleep portion of the show. But so we've got a lot of ground to cover today. So my presentation objectives, just because tax content is dry, it is a hard subject matter to present on. I'm really focused on the context of the relationships that I have with different advisors, what I feel like you as a firm owner really need to know about this function. So the goal is really the focus on red flags and not, I'm going to sit here and teach you how to file an S election. I'm going to go over some of the complexities, but the goal is really to keep everything action level for you because you're spinning so many plates, and truth be told, tax planning is not a profit center for you. It really should be in the relationship that you have. And so my goal for today is that you know what you need to know as a firm owner to be a confident conversation partner with your tax professional. That's the goal, is that basically what do you need to know in order to get this done efficiently? So a little bit about me for people who aren't that familiar with me, or if this is your first time engaging. My name's Catherine Tyndall. I'm a CPA. I'm a principal at Dominion Enterprise Services. We're a niche CPA firm that serves the wealth management industry. We work for the firms themselves, not for their clients, doing their strategic tax planning and the tax returns for the firms and their owners. That's our niche. Me personally, I've had over 16,000 people attend my continuing ed presentations. So hopefully that means I'm getting better at this as time goes on. And, this is not a live presentation, but if you have questions for me, feel welcome to send me a DM on LinkedIn. We'll also include my LinkedIn handle in the show notes. I can't give specific tax advice out of engagement. So if you ask me something really technical and personal, I'm not going to be able to, I need more context. And also, it's just a licensing requirement, but generally pointing you in the right direction for resources or helping you get your bearings on things. I'm always happy to engage with that. So please feel welcome to reach out to me on LinkedIn and we can chat. So main points for today, we're going to start off with the know what you owe. So I always joke, I can't tax plan on a spaghetti. So you need to have a strong record keeping and forecasting function in the business. And what that means is correct, projected P&L and balance sheet. So I need financials that are for what has already happened in the year are correct. And then also for the rest of the year, we have a reasonable basis for forecasting because unfortunately in the US, you can have a really stellar first 6 months of the year and a really terrible last 6 months of the year. You're going to get taxed on the average, potentially at the trough if the bad part of the year is the end of the year. So we really need to be looking at things at an annual level when we do forecasting. A lot of times I'll see firms, especially if you've got a lot of change going on in the business, this is even more essential. And then once we've got those forecasted financials, then we can run a tax forecast. So if you're going to make 500 this year, if you're going to make $1 million this year, whatever it is that you're going to make for net profit out of the business, great. We can run that through the tax projection and figure out what that turns into for an actual tax liability before the end of the year. So then we can make a plan around it. Are we happy with it? Do we want to try to lower it? How are we going to pay for it? So you need to have a strong tax professional relationship for that as well. So if you only take away two things from this whole conversation around tax planning. Really, one of them is if you really want to save taxes, the best way to do that is having a systemized relationship with it. So getting it off your plate, having a relationship that's serving you, having good record keeping, and having a strong tax professional relationship where they're focused on planning so that they're catching things in advance. They're catching opportunities before they go by, and they're also catching problems before they're right in your face. So the next step is where do you want to go, which is a cute way of saying what are the goals in the practice, right? Because the planning advice that I have for somebody who's a year away from retirement is going to be very different from the planning advice that I'm going to have for somebody who just started their breakaway RIA. Very different, right? And so the general buckets of things that I tend to look at is you can have practice that are very high in organic growth. So they're doing a lot of acquisitions, they're doing a lot of reinvestments, they're very dynamic. And that's not to say they're better, but it's just a different style of firm. It's going to be a very different tax planning setup than for your stable organic growth practices where, okay, we're growing 15% every year. We're going to add headcount as we need it, but we're not really getting aggressive. It's going to be a very different tax planning regime for that firm. And then just other issues like if you're going to be selling the practice, we don't want to tank your valuation. If you're going to be acquiring, practices, you're going to have additional cash needs that are going to be different. You're also going to have financing needs. You're maybe going to have some additional operational drag that are going to change some of the recommendations that we. And so I always start off with what's going on this year, what's going on in the next 5 years. And so we want to dovetail all of the advice based on, overall what's going on in the practice because we want it to dovetail. So we start off with, okay, we've got our forecasted financials. What's our actual current liability? Great. Do we like it? Do we hate it? What do we want to implement this year? And so that's specific planning techniques, which that's going to be what the rest of this presentation is talking about. And then once we've decided what we're implementing for this year, great. It was 100. We got it down to 75 or we got it down to 50. How are we actually going to pay this 50? What's the strategy for that? And so most of the time you're going to be doing quarterly estimated payments. And the focus is really meeting safe harbor requirements. So if you're in a firm that's growing, typically your safe harbor requirement will be less than what your actual tax liability is. And why I usually recommend people actually pay in their safe harbor is because you really don't get a benefit to prepaying the full tax liability. So say you actually owe for, tax year, we're recording this in 25, tax year 25, your tax liability for the year is 100,000. Your safe harbor, which was based on the prior year, is only 50,000, say. You don't get a benefit to paying that 100,000 in early other than, maybe some peace of mind, but I think you can achieve that other ways, which I'll talk about, is that you want to pay in that 50,000 safe harbor and then earmark that second 50,000 because you're going to need that money to pay it to the IRS into a tax savings account of some kind. I have some people where they'll put it into a stable brokerage position. I have some people where they put it into just a special savings account, but you want to earmark the difference because you don't get any benefit to prepaying it to the IRS and it can be earning interest for you. But also if there's any changes that happen, the only way for us to get refunds back to you is by filing returns. So if you pay in too much, it's going to end up getting lockboxed over at the IRS until we can file a return. Say you have some catastrophe happen and you need that money back. So that's why I don't recommend prepaying the full liability. Now there's another little sneaky technique here with you can do IRA rollovers if you get really behind on your withholding, which you can just send me a DM if you want to know what that's about. The other option too that you've got is if you get really behind on estimated payments, if you pay yourself a W-2 because you're in an S corporation, if you pay withholding through your W-2, it gets treated as if it was paid during the whole year. So if you decide in the end of December that you actually want to pay an extra 50,000 through federal withholding through your W-2, and then you just make sure that your payroll company doesn't bump up your actual wage amount, it'll get treated as if you were paying that 50,000 evenly over the year, which can be really nice to catch up. Okay, so that's the general schema of how we think about tax planning structurally. You start with the forecasted financials. What are we going to do for techniques? Great. Now we've got the updated tax liability. How are we going to pay that? Let's back up and start talking about planning techniques. So the first class that I'm going to talk about is the cashless. but not 100% painless, tax planning techniques. And then we'll talk about strategic cash moves for tax management. So why do I emphasize cash? Why do I emphasize cash as the major decision point with planning techniques and the category splitter? And it's because at the end of the day, when I do tax planning, I'm optimizing for three things. The first thing is when I talk to firm owners and we look at kind of what's going on in their financial situation, most of the time, the biggest asset in their portfolio is their business. And so if I'm going to be doing tax planning maneuvers, I better be dovetailing with the value generation of that asset. I better be contributing to that exit multiple with the work that I'm doing. So we always want to do things that are going to dovetail ultimately with that goal, whether it's for a sale in a year or a sale in 10 years. We ultimately want to be driving towards that goal. Then we also want to make sure that in the process of doing things, we're not running out of cash, because cash is the oxygen for the business. If you run out of cash, you're done. So we want to make sure that we've got a good handle on what's going on with cash. And then the last component, and probably the most important component, is your mental sanity and your time, right? Your quality of life. What's the point of any of this if you're not having a good and fulfilling experience with the work that you do? So I don't want to be suggesting things that are going to take on more of your energy or take on more of your time, because that's very expensive. So I start with the cash planning, the tax planning, focusing on techniques that do not use up cash first, because if we're going to use cash, which is the oxygen of the business, it better be producing a return. And so it's just much harder to be able to guarantee that. And so I always emphasize things where we're already paying for things out of one pocket and we just want to switch it to another. And that always, when thinking about tax planning, we want to keep the true opportunity cost to the advisor in mind. Something that we do for people, because it's part of the S corporation requirements, is a reasonable compensation study, which I'll talk about that a little more in the follow-up, is that it's actually good to do an annual time study to know the value of your time. Because when you're considering different techniques, or you're just considering different business opportunities or things you're going to be doing, how valuable is this activity really when you think about the opportunity cost of your time? And the way that I usually calculate that is, what's your W-2 compensation from the business, plus what's the profit distribution that you're getting from the business? Divide that by the hours participation, and that's the rough current value of your time. And so anything that's on an hourly basis lower than that either should be getting delegated or deleted. And ideally, that number should be rising over time, because the business should be getting more profitable and your participation should be hopefully going down. So it's good to have a sense of what that actual dollar figure is, because then when you're evaluating different opportunities, you'll know the actual cost of it. Because if you're going to start doing things like a real estate side hustle and it's taking up 10 hours a week of your time, is that actually producing as much of a return as, say, cracking your marketing and getting really, or having a hard conversation with your clients to raise your fees? Ooh, yeah. So cashless tax planning. So I don't like the advisors to waste their time on things that they could be better spent on, things that are maybe harder, but are going to actually produce a better return for them, just to try to save some tax waste. Most often where I'll see this is with real estate or hobby ventures. If it's a passion of yours, if it's strategic, if you would be doing it without the tax savings, and I have no qualm. I just have some people where they want to pursue tax savings, but they don't realize the full opportunity cost of it. And, one thing that I will mention is that if you do decide that you want to start getting into real estate, in the tax code, there are not a lot of opportunities to save taxes in ways that, you're not going to end up with an IRS agent sniffing around. Real estate depreciation is one of them. It's a great strategy. You can game it with cost segregation studies, which I will talk about. It's a bit tricky. It's cumbersome from a reporting standpoint, but it's one of the few legitimate ways that you can really significantly reduce your tax burden. As a firm owner, is it strategic for you is the bigger question, right? So if it's going to be a strategic part of your portfolio and you have a passion for it and it's not distracting your energy to slow you down from building the practice that you should be building, then great, bring it on. If it's just something you're going to be half-hearted with. We want to minimize the participation in it as much as possible. So actual planning techniques here. First one I look at is entity choice, because that's just a matter of us filing some elections, setting up some administrative components, and then, you just kind of rinse and repeat, annual savings kind of a thing. So we're going to talk about behind the curtain of the Magic S Corp. I always have people ask me about should they be an S Corp or what's going on with S Corps. So we'll talk about that. We'll talk about the fringe benefits and reasonable compensation requirements of the S Corp, which are the main components there. And then we're going to look at one pocket to another deductions. So these are things where you're already paying for these, or it's just a matter of some, Catherine doing some Excel magic in order to get it. So we look at those kinds of things first because they're easier lifts to see if we can get them. And those on the list are the pass-through entity tax, QBI optimization. We're going to talk about statutory W-2. So if you've got that going on, we'll talk about that. We'll talk about hiring kids and spouses. We'll talk about health accounts. One thing that's in this category, but I'm not going to talk about it because it's bread and butter for most advisors, is portfolio loss and gain harvesting. So, if you're not already currently doing that and you've got brokerage positions going on, you'll probably want to do that. And then we'll talk about cost segregation and other sneaky or missed deductions. So just things that, I see people miss. So S corporations. S corporations, should you be one? Should you not? It's a big question. There are a lot of nuances to it. I'll probably do a future episode talking more specifically about this. But the main mechanism by which it saves taxes is that it limits your self-employment tax to what you pay yourself as a W-2 employee of the business, which is a number that you get to pick. It needs to be reasonable. The long story short of reasonable compensation is we use a tool called RC Reports. You fill out the hours that you do. Usually we do a multi-hats approach where it's what are the different things you spend your time on in the business? What's a reasonable market compensation for those behaviors? Long story short, that's the main mechanism of how you determine reasonable compensation. There's a number of ways to do it. If you're looking at this, if you've got a copy of these slides, there's a link in there to RC Reports. You can just send me a DM about it if you're interested in it. Usually I'll have people where reasonable compensation is like, oh, he picked a number out of a hat, or 30% feels reasonable. That's not the way the IRS looks at it. So you just want to make sure that you're following a methodology that they use, either by doing market comparisons or figuring out, how you're spending the different parts of your day or your week to make it a reasonable figure. If you were to replace yourself, what would you be expecting to spend on a market basis? And so once you've done that, usually for most people, it ends up either, and then that gives you the floor. So you can always pay yourself more if you want to, if it's strategic, if you're trying to max out retirement contributions, but that reasonable compensation is the floor. Usually for most people, we push to use the floor because unless they're doing really aggressive retirement contributions, we don't want to be paying additional self-employment taxes. And then the other mechanism that the S corporation allows you to do that brings in a lot of the savings is paying for your state taxes through your entity, through a pass-through entity tax regime. This is something that each state is different, so it really depends on where you live. And so it allows you to get around the SALT tax limit. So for a lot of people, it's $10,000, especially if you're a higher earner. They did bump it up this year to 40. If you're under 400,000 of AGI effectively. But for most people, they're going to be in phase out ranges for that anyway. So being able to do that payment through your entity for your state basically gets you a better deduction for that. And so we'll talk about more of the mechanics of that. So just to give you an example here, say you've got an S corporation, you're paying, you're doing a state PTET payment, and you've got a 6% rate married filing joint. If you've got 500,000 of profit, so after all the business expenses are paid, and you've paid yourself 120,000, which would have been deducted on the entity return, but you pick it up on your personal because it flows through on a W-2, and you pay that PTET payment of 30,000. So you're paying your state 30,000 through the business instead of through your personal account. Rough savings for that would be 35,000 on the federal level annually. So it's money that you're already paying from one pocket to another, but it saves you 35 grand to have the structure on an annual basis. So it's pretty nice. It's, and then especially with the entity filing, you would have already had to been doing a lot of that complexity just to file your Schedule C. So it's really not a huge jump to switch that entity filing. So S corporations, a couple of caveats here. Fringe benefits typically get added back. So a lot of times people say, oh, well, if I have an entity, I'll be able to deduct more things. Talk about that. Usually no. Need to do reasonable compensation. If you've got multiple owners, so if you've got other partners, S corporations can be too rigid because they don't allow for unequal distributions. So you got to watch out for that. You also have, if you're with a broker dealer, assignment of income issues. So what I mean by that is, say you spin up this entity, but your broker dealer is still 1099ing you personally. That income still is going to have to show up on your personal returns. There are some ways around this. It's a needle you got to thread, and it's very nuanced to your particular situation, but it can create issues. So you just got to be aware of that not everybody's going to be able to be in an S Corp. It may not be appropriate. And then for non-RIAs, this is going to be particularly an issue. For most RIAs, this is not going to be as much of a problem. So the next category we're going to talk about is more detail on that pass-through entity tax program. Basically, it takes advantage of a loophole where you're just paying the corporate taxes. You're paying your personal state taxes through your entity. And this is particularly helpful for people who don't itemize too, because you're basically kind of getting to double dip on dollars. It varies widely state by state what the benefit is and the way that they calculate it. But typically how it works in most places is that the benefit you get is your top bracket rate. So for each dollar that you pay in pass-through entity tax payment, you're going to get a write-off of your federal bracket rate. So example is if you pay 20 grand in PTE, you'll save 7 grand of federal taxes. That 20 grand you were going to have to pay either way. So it's nice to save that 7 just for the fact that it came out of the corporate checking account instead of your personal checking account. So it's a great program if you can do it, but you have to be in an entity to participate in it for the most part. And, it's not always advantageous, but definitely something to look at. Another pocket-to-pocket optimization is the QBI deduction. So QBI optimization is often something that I see missed on returns, is having an active hand in making sure that QBI is being optimized. And if you're not familiar with it, the QBI deduction is basically a 20% deduction on the profit from eligible business income. So if you make $1 million that's all eligible for this treatment, you'd get $200,000 of a deduction, and that's basically going to give you a tax savings of your bracket rate. So one of the components that you need to know about this, because there's different phase outs and there's different, you got to pay a certain amount of wage payments and things like that. The main thing that you should know is that if you've got statutory W-2 income because you do a lot of insurance work, or if you're an RIA and you've got a significant revenue stream that is insurance, that can be potentially classified differently than normal brokerage or advisory income and have a better beneficial treatment. And so long story short is that if you've got that going on in your situation, or you've got a significant portion of insurance activity going on, this is an active conversation you should be having with your tax professional. Or if your income roughly hovers around that 400 to 500,000, this is also an active thing you should be looking at, because you can game some of your QBI deduction based on controlling your profits and how much you pay yourself in W-2 wages, and it can be significant. So I had a recent client case where they had significant insurance income, and basically the prior CPA did no QBI planning for them, and they were paying an additional $70,000 each year in taxes just for the fact of, doing some of these optimizations on Excel and just gaming the numbers. So it's one of those things where if you've got some of those components, if you've got a lot of insurance activity happening, or you're close to the phase out thresholds, it's an active plan and conversation you should have during the year, because it can be very expensive to just not have an eye on this before you can, make changes. Because once you get to the end of the year, if you have not optimized QBI, you're just stuck with whatever the calculation is. So another pocket to a pocket is family activities. I know for a lot of advisors and a lot of our clients, we have family members involved in the firms. I always joke, when somebody's got teenage kids, do the kids need a summer job? Can they lick stamps for, client appreciation cards? But no, more in reality, how I advise on this is when you're looking at hiring your kids, the basic mechanism here is they have to be working for the business. So they actually have to be doing something that you would pay, your neighbor kid to do, like not just the fact that it's You're just trying to get a write-off for it. But basically the mechanism is if you can pay the kids, it's now going from your high bracket to basically free until they hit the standard deduction amount. And so that can be really attractive. I think if it's a strategic part of what you're doing that you want to get your children involved, especially if you're trying to suss them out for potentially joining the business and being your succession plan, it's a great maneuver. But in general, you can't just do the, I posted the Facebook ad of my 2-year-old and now I'm paying them $15,000 of wages. That's not going to work. Has to be realistic, but it can be a really wonderful technique, especially too, if you can combine it with doing some Roth contributions for them too. For what I see typically more often can happen too, that's actually a nice little maneuver, is if you've got adult children in the business and, the grandbabies are starting to come on the scene, you can actually get, as an employer, family leave credits for parental leave for wages that you're paying to your adult children when they're going on maternity or paternity leave. So this can be significant. We had a client this year who was able to get a $15,000 tax credit for money that they were going to pay anyway while their adult child was on parental leave with a new grandbaby. So that can be a nice little boost. It's one of those things where the calculations for it actually are not that horrible. You do need to have a written statement on file, and there's some other caveats, but it can be easy to track and easy to get. So you should have an active conversation with your tax pro if that's something that's going on for you this year. When dealing with family members, you have to pay them market wages for bona fide services. So you got to be reasonable with things, especially with the teenagers. If you're going to be hiring them and you have 1099 income going on, so say you've got a significant portion of your income's not eligible for an entity, it can be better to hire them under a sole proprietorship, under that 1099 class income, because you don't have to pay self-employed taxes for them if they're minors. With hiring a spouse, it's a common question that I get. Usually you don't really get much of a benefit out of it, other than, there are some contributions towards, if you've had a spouse who has not had a lot of Social Security earnings during the course of their life, it can be a nice way to get some of that. I don't know how beneficial, honestly, that actually is. The main benefit that I see with hiring a spouse, though, is them being able to participate in retirement plans. So if you do end up in a strategy where you're trying to max out 401ks and things like that, it can be helpful to have your spouse, involved, because you can bump some of those things up, but they do need to be actually working for the business. A couple other spousal benefits, you can look at things like medical expense reimbursement plans. Always want to make sure you're looking at married filing joint versus married filing separate, if your tax pro is not looking at that or hasn't looked at that in a while. And then things like the 529, the HSA, spousal IRAs, those are all categories as well that you should be looking at, because it's one pocket to another kind of things. So last two that we're going to cover quickly is cost segregation and gift leaseback. So if you own the building that your firm operates out of, doing a cost segregation study can be very helpful because it accelerates the depreciation on the building. So if you're going to be in the building for a while or you don't plan to sell it, accelerating depreciation can be a helpful technique for that, especially if you're in a position where there's not a lot of cash going around, but you're still in top brackets. It can be a nice thing to do to accelerate that depreciation. I've seen it really varies on what is going on with the building itself. Sometimes we're able to accelerate 15% of the building cost. Other times it's 30%. Really depends on the building itself. And you have, there's a number of steps that you have to go through with it and other components, but it's always a strategy to look at if you're thinking about buildings. Another opportunity you should think about as well, for those of you who support family members, is the gift lease back strategy. So if you have an elderly parent that you support and you own your own building, you can gift them that building, and then they can charge your business rent. And so instead of, if you're paying $50,000 a year for their support and maintenance, versus if you could transition that $50,000 to deductible rent for yourself, you're not having to pay the taxes on that $50,000. It's a hard needle to thread, but it's something that I find a lot of people don't see it as a strategy. Also, not to be morbid, but if you have somebody who you anticipate is going to predecease you, you can get a step up in basis on that property too when it comes back into your hands. So, all right, strategic cash moves for tax management. So those were my cashless techniques. So I always like to use those first because they're much more painless. Now we're going to talk about strategic cash moves for tax management. So I'm going to talk about retirement contributions. I'm going to talk about deductions in my categories of the good, the not great, and the ugly. The good is strategic growth deductions. The not great are things like Augusta, auto mileage, home office. And then the ugly are IRS easy pickings, basically talking about kind of general methodology of deductions. One of the main categories that I actually don't address in this webinar, and I'll probably do a separate podcast on this soon, is talking about charitable, because it's so idiosyncratic to the advisor. One thing I just wanted to bring up is if you do a significant amount of charitable giving, you'll want to consider doing something like a donor advised fund. It gives you privacy. It also gives you control over, okay, say you want, it makes sense to strategically put in an extra 100,000 this year into it, but you don't want to meter, you want to meter that out to the charities or religious institutions that you give to. And so you don't want to just flood them with 100,000 and then now they're going to expect that every year. So donor advised fund is great to allow you to have tax planning control, but then normalize the relationships with the institutions you have, you're giving to. And then it also allows you, if you've got appreciated positions in your brokerage accounts, to be able to get the full write-off for that appreciation without having to pay the capital gains on it. So if you've got a position that's appreciated 50,000, you're going to get a write-off for the 50,000 without having to pay the capital gains tax on it in order to get it. So they can be really great vehicles for that as well. But if you're interested in charity, send me a DM, because I'd be interested in seeing what people would like me to do for content related to that. But it doesn't apply to everybody, because it just depends on your temperament. But anyway, so we're going to talk about the other cash tax planning techniques here. So retirement contributions, please don't send me a nasty Graham DM about this. This is where our worlds collide. So my general philosophy with retirement contributions is it's your life. You're a well-educated and reasonable person. You can do as you please when it comes to this. My one devil's advocate position is just consider the opportunity cost of the capital. So if it's $1 that's going to get locked up in a pre-tax account and you're going to get slapped on the wrist to try to take it back, is that strategic for what's going on in the rest of your life? Is it strategic for overall wealth building goals with some of the exit multiples that go on right now? Is it strategic for de-risking your portfolio? Which usually positive, yes. Could you achieve similar protections with using non-qualified accounts? Where you're paying the taxes, where it's a known quantity today, and also where you've got the ability to generate more upside. So you're in years where you can generate more revenue, you can generate more income. Do you want to be stuck in a forced position where you're having to pay taxes and having to take out RMDs when you do not have the ability to generate additional income? So those are all things that I think, and then decide accordingly. So I always look at the retirement contributions last, because if we do everything else in the kitchen sink and there's really nowhere else for us to really park dollars, then I look at retirement contributions. But it's a tax deferral. It's not a tax savings. So it's a very different kettle of fish in my mind. If you do it, don't forget tax credit for employer plans, especially if you're doing them to attract talent, which I'm very pro. I find a lot of people, they're able to, it's a helpful thing. If you're close to retirement, you might want to think about doing a defined benefit plan or cash balance plan, just because when it's a known time commitment, like I'm 4 years out from retiring, I don't mind making this commitment. It's only a couple of years and I'm in my highest earning because AUM is as high as it's going to be. Great. We can try to do some income smoothing with some cash balance plans. And then a lot of times, which I'll have to do a whole other presentation on succession planning, it dovetails nicely with succession planning usually, because you can do the cash balance plan and then off of the back end, you do an installment sale if it's an internal succession plan. And so it can really nicely income smooth out those final years before retirement. One component though with those and just general retirement plans is you just have to watch out if you've got employees discrimination testing requirements, if you have employees, and then just thinking through, what stage the business is at and is it strategic for talent acquisition, things like that. So going on to my favorite technique is strategic growth deductions. So what do I mean by this? The best tax savings, the best vehicle for tax savings for somebody in professional services in the US tax code is going to be investing in your growth. And what I mean is accelerating strategic deductions to defer your income tax by artificially lowering your profit margin. And so example of strategic deductions are things like professionalizing the business through a piece of software, administrative infrastructure, hiring an executive assistant, doing a coaching program, acquiring talent, doing some outside consulting, doing some marketing. Now, you'll notice on here something I don't include is partial book acquisitions. Part of that is because I'll have to do another presentation just on succession planning and exit and acquisition, is that when you do practice acquisitions, you don't get to deduct what you paid for it. So if you buy a partial book of business from somebody for $200,000, you do not get a $200,000 write-off in the first year. You only get 1/15 of it. So it's not really going to lower your taxes in order to do that. It's just going to burn a lot of cash. So it's not a strategic growth deduction. But let me give you an actual example of this. So for those of you who can't see, I apologize because I think seeing this visually makes it a lot easier to see what I'm pointing at. But basically, for those of you who can see the slides, this is going to be a lot easier. When you don't do strategic reinvestments back into the practice, so say you've got a practice that's doing $1 million a year of revenue, pays $300,000 of overhead, pays you as the owner $150,000, that's going to leave you an operational profit of $550. If you do nothing, you will pay taxes on the $550 plus the W-2. And so your taxes for the year are going to be, in this is just all, rough numbers to demonstrate this out. Taxes for the year around $150. You're going to have roughly an owner take home of $550 if you do nothing in that scenario. If you do strategic reinvestment, so you got the $1 million of revenue, got the $550 of operating profit, already paid yourself $150, and you say, okay, I've got $550, I'm going to spend $250 on strategic deductions. And those are things that are reinvestments back into the practice. So it's things that you have a reasonable expectation of return on. It's not, gambles or I'm going to buy an SUV to get the write-off. These are things that you expect them to produce a return. Taxable profit down to $300, tax is only $63 now. So it saves you roughly $85,000 in taxes. That's a pretty nice write-off. Now your take home is less because you're spending money on strategic deductions, but if that money's going to be producing a return for you, where else would you be putting it? So, you can control that strategic deduction number. I usually recommend people, what do you actually need to get out of the business? And then let's look at what's left over. And then you can decide what you want to do with it. Just knowing that if you just leave it as taxable profit, you're just paying taxes for it. And if it's not actually producing a return, why pay taxes on it? So the big kicker with this in this scenario is, you're saving that $85,000, you're having to spend $250. Okay. That's okay. But how I like to think about this that makes it actually valuable is, so we take that $250, and this is ambitious, but it's just an example, is say we take that $250 and it generates a 50% return on investment in an increase in annual recurring revenue. So you invest $250 into different marketing programs and professionalization and consultants, et cetera, and you're able to get an additional $125,000 of annual revenue through doing those different things. Great. At a 2.5x exit value on revenue, which is not unreasonable with a lot of the succession planning I've been seeing, that 250 is going to generate an additional 312 of exit value. Awesome. What I like about that too is instead of this 250 that was getting taxed at ordinary income tax rates, this 312 of future exit value is only getting taxed at capital gains rates. It's not going to get taxed at ordinary income tax rates. Now, in the next year, so in 2026, when you get that additional revenue, if your expense infrastructure isn't up, that 125 is going to be additional profit that's subject to income tax, ordinary income tax rates. But in general, I like the arbitrage here, so if you don't need the funds for your personal, needs, and you're confident in things that you can reinvest in the practice to speed you up to whatever end state you want the practice to be. If you're not at cruising altitude, so to speak, what can you do to accelerate the practice to grow the way that you need it to grow for what you want? Because a lot of the time I will find with firm owners, they can get themselves stuck in these burnout positions where a lot of times it's, okay, what's the gap here? Is it a knowledge gap? Is it a skills gap? Is it a support gap? Do you just need to hire somebody? Do you need an employee? Do you need a piece of software? Do you need a consultant? Do you just need an extra set of hands? Do you need an assistant? What is it that's holding you back from the end state of where you want to be? And can we aggressively reinvest back into the practice to get that? Because you're going to get a tax write-off, but if you do this wisely, you should be getting increased exit value. So that's great. And imagine if you're able to do this for, say, 5 years, how much additional exit value is that going to be? It's really significant. So that's why when I think about tax savings, this is the main mechanism. It's doing this. And being able to make sure that these are investments, not just expenses, is essentially what makes this mechanism work. So that's the great. The not great, or that's the good. The good, the not great, and the ugly. Not great. Augusta rule. That's a common one people will ask me about. It's a self-rental of personal property up to 14 days tax-free. So this is basically where, you throw the holiday party at your house with the clients and the employees, and you pay yourself personally for your business renting your personal property. If you've got a beautiful home and you have a spouse who wants, dabbles in event planning, and it makes sense because the value is going to be enough, it's a good strategy to deploy. It's just often cumbersome and juice not worth the squeeze. But if you're already going to be doing those things, you might as well get a benefit out of it. Same thing with auto mileage. So I have a lot of people where they say, oh, I'm going to buy a vehicle. Can I deduct it? All comes down to, well, how much are you actually using it for business purposes? Are you going to spend additional money on this to try to harvest a better deduction because of the gross vehicle weight rules? I'd rather just see that money invested into something that produces a return, unless you're a gearhead and or you have a particular affinity for a vehicle. Because would I rather see 20,000 put into improving a vehicle, or 20,000 put into a niche consultant who's going to fix the problem with your lead flow? I'd rather see the money go into the second one myself. But if you are going to do a vehicle, tracking your auto mileage is important. There's a link. MileIQ is what I usually recommend people use. Just know that you're only going to end up getting to deduct what you actually use for business. So if you don't, if you run a completely remote practice, it's not going to generate anything for you. And then for home office, it's got to be an exclusive business use of a section of your home. So it can't be like a dining room table. But if you do have a home office, which I have some people where a significant portion of their property is their home office, it can be a wonderful deduction if it's a lot, because we're able to deduct a lot of things that are shared use. So things like snow plowing and landscape improvements that impact the whole property. You can deduct those, but unless it's going to be a significant portion of the home, it's usually not worth the squeeze. One thing I like to mention, just because it's kind of out in left field for a lot of people, is if you do end up doing a lot of property improvements to your primary residence, you want to keep copies of all of that, because when you go to sell that property, you want credit for all those improvements so that you're not paying capital gains tax on money that you should have gotten credit for. So just make sure if you do any improvements, you keep it. And then if you do sell a property and you're starting to get into that capital gain zone, because you've got more, you're above the gain exclusions, which don't index to inflation, just make sure you get credit for that kitchen reno that you did. And then usually for the home office thing, it's a lot of times for the cost of the bookkeeping, it's just not, and your own mental energy, it's not worth it. So unless it's significant, usually we just let it go. So last category, we're going to talk about the ugly deduction issues. So I want to talk about both sides of this. So I see a lot of advisors who are very skittish of taking deductions, and I see other advisors who should be more skittish of taking deductions. And I think the general frame that you should have when thinking about this, of should I write this off in the business or not, is it an ordinary and necessary expense for the business? Is it like a reasonable expectation? if you were running this business with your next door neighbor and your next door neighbor wanted to buy the Ferrari and write it off as a business expense, how okay with that would you be? It's, you want to deduct things that it would be reasonable for somebody to call it a business expense. If there were no such things as taxes, would you be paying it out of the business category, or is it really a personal category thing? So just be reasonable with it. But then I see some people where they're, gosh, I can't even think of a good example off the top of my head, but just like the fear of, okay, well, I don't write off any of this stuff because, well, what if they're going to scrutinize it and I don't keep the receipts for the meals, so I don't write off, the $5 coffee that I got with the client. You don't have to be that fastidious with it. But one caveat is if you are, going out of the gray zone in the wrong direction, just know that the IRS is starting to implement AI for enforcement. Right now I'm recording this in the government shutdown, but it is something that's on their docket to automate a lot more of this and use more AI technology for red flags and things like that. So we'll see what that ends up being. You're always run the risk of random audits, but most of the time they're going after things that are improper large deductions. So like if you're 100% deducting a vehicle, if there's personal travel or personal living expenses, or you're trying to deduct household employee wages as W-2, like those are the things that, where I get more concerned about, or, hobby things that are kind of rolled up into the business, I can get concerned about. But I think for the most part, if it's ordinary and necessary, if there's a reasonable business motive with it, you don't have to be, overly cautious. But this is going to be one of those, talk to your tax professional. I can't give you tax advice. It really comes down to the individual situation. But, more often than not, another thing that you can do as well is just when these things come up, ask about it, because especially if it's going to be something that's going to be a consistent part of your expenditures, like, can we deduct this? Is there a way to shift this from being non-deductible to be deductible? A common conversation I have with people is, they want to support charities, and, is there a way for us to turn what normally would have been a charitable deduction into an advertising expense? Like, there are ways to do that legitimately, but it's a needle that you've got to thread. So just be reasonable with it. Don't fly too close to the sun with the deductions, but at the same time, you don't have to be hyper fastidious with these. One other ugly component that has come out of left field in the past for clients that I've seen is if you've got a lot of people on 1099 compensation, just be careful that you're following the guidance with who should be a 1099 and who should be a W-2. Who I've seen get aggressive with this is state unemployment departments is actually who gets aggressive with this, and then it can cadence into an IRS issue. So just make sure that you're following the guidance there with it. There's a number of factors that get looked at. If you've got the slides, there's a link to the IRS guidance, but you just want to watch out for that if you've got some significant 1099 income going out, or if you've got, sub-advisors working for you where you're 1099ing them. So if you're an RIA and you're 1099ing your, some junior advisors, just make sure that you're kind of staying within the lines with some of these requirements. So those were the main tax planning techniques for today. As a bonus, which maybe we'll just break this off into another quick episode or a break, is the one big beautiful bill updates. I'm going to talk through this one a little more quickly, just because I've already had your studious attention for, I think we're almost at the 50-minute mark here, but big updates that impact you as a firm owner. The QBI deduction was made permanent, and some of the thresholds were advanced. There's a couple other components that got improved, like Section 179, the business interest deduction got relaxed. There was the SALT cap changes, which we already talked about. One thing that's a nice improvement, especially if you've got a multi-generational firm. So if you're a parent and you've got children who are working for you, or and grandbabies, you're in the realm of the arrival of the grandbabies. The Trump accounts can be nice because as an employer, you can get a write-off for those with the tax deferral, and you can contribute on an annual basis. With the estate and gift tax exemption got raised as well. Itemized deductions are getting capped at higher incomes. So for people who have significant charitable, this could end up being an issue. Or if you're going to do a significant charitable bunching strategy, this could be an issue. And then also for charitable in general, there's some more limitations and a new floor introduced. But if you're a consistent charitable giver, you definitely talk to your tax professional about trying to work through that one. And then the tax brackets and standard deductions, basically some of the bracket information is got fixed, and then the standard deductions got bumped up. So, and then indexed annually, which is nice. So on the SALT cap, just to talk a little bit more about what's changing with that. Basically, the deduction is capped at $10,000 or $5,000 for married filing separate. That's what it was pre-2025. Now in 2025, the cap increased to $40,000 or $20,000 if you're married filing separate or single. The phase down begins at $500K in 2025, increasing 1% a year. So basically, this deduction it's at 40, but it's scaling down. And basically, it's going to return back to normal. Not normal. It's going to return back to the TCJA level by 2030. So hopefully they will actually fix this. But for most people, if you're operating in a pass-through, you just continue to use the pass-through entity tax programs to work around this one. Unfortunately for your clients, unless they have an entity, they're just going to get hit with it, and there's not a lot they can do. For the charitable giving, 2026 itemizers, you're going to lose 0.5% of AGI, which for most people, it's just a minor haircut. So I don't even know why they bothered to put this into the tax code, to be honest. Let's see, what else do you really need to know on this one? If you're going to do a really significant charitable gift, just make sure you have your tax professional do some forecasting for you to make sure that it's going to work, because they have new AGI limitations. And then they have like this little token thing for K-12 scholarship donations, which seems kind of like a pain for trying to get the tax credit. And then a couple other changes. The mortgage interest indebtedness 750K limit was made permanent, which is just so annoying in the current housing market that they limited that. Some other differences on some wagering loss deductions. If you've got people with significant gambling, you might want to check that out. And then miscellaneous itemized deductions finally got repealed. So that's a change. It's not really a change, but that's in there as well. Some of the auto loan interest deductions improved too with vehicles, but doesn't impact most people. So, those are kind of the highlights for the big, beautiful tax plan. And so for the main points today, to just kind of go back to the top and summarize this whole thing after we just went through the weeds is, when you're looking at your own tax planning, the first step is you got to know what you owe before we even think about planning. So what is your forecasted income for the year? Do we feel reasonably comfortable with that number? Great. What would you pay in taxes if it was the end of the year today? Okay. Are we happy with that number? Or are we not happy with that number? What do we want to do? And what makes strategic sense in the context of everything else going on in the practice in your personal life of what we want to try to pull for levers to fix that? First, we're going to look at the cashless planning techniques, because most of the time it's just going to be your CPA Excel magic and some form filing in order to get that stuff done. Then we start looking at things that are going to cost cash, because I always want cash performing. I always want it to be producing a return because it's expensive. It's the lifeblood of the business. Money that is spent on these things cannot be spent on other things. There's a direct opportunity. There's a higher opportunity cost in a lot of ways. So we look at the cash next. And then, usually in the last tangent of that, I'll look at the retirement contributions as the last piece. But so that's the basic cadence. And then once you've got down the techniques that you're doing, you implement them, you pay for things, then we look at okay, this is the new tax liability. How are we going to pay for estimated tax payments? Starting off with paying your safe harbor amounts, because you don't get a benefit from prepaying the IRS. And then we look at earmarking the difference to then pay it over to the IRS. So if you owe 50 in safe harbor, you pay the 50. If you owe an additional 50 because it's the actual real tax liability, You want to have already been saving that 50 during the year when the revenue is, to align with the revenue and the tax payments, but put it aside in a separate account and earmark it knowing that it's going to have to go over, but at least earn some interest and make some money on it in the meantime, since you don't get a benefit from doing it early. So that's the basic cadence. So next steps, I would love to hear if we actually hit the goal of, do you know what you need to be a confident conversation partner with your tax professional after this? Did we get there? Send me a DM, let me know, leave a comment. Was this useful? And then from here, a couple of follow-up things. So I'm active on LinkedIn. I would love to hear from you what you thought about this and, your commentary on it. Or you can join my sporadic tax newsletter for advisors. It's the same content that I give to our clients. So it's not really a marketing piece. It's more of a, it doesn't cost me anything to help you through a tax newsletter. So why would I not do that when I'm already putting this kind of content together? I might as well. It's a useful thing. So join the newsletter if you're interested in that. But if you're finding that, I really just need to make a change, or I need to see what's under the hood, you can reach out for us to talk about doing a tax assessment, because basically our first stop with working with clients is that we look at, we have an initial planning engagement where I look at your record keeping function, make sure that it's working for tax purposes, it's also working for what you're doing. And then from there, we come up with a plan of any record keeping issues that need to be addressed in that function in the business. Then we look at your tax returns of compliance issues. So if there are things that are IRS-ish problems, you need to be aware of them. And then we can decide on if, how they should be addressed. And then we look at, are there planning opportunities? Were there things that you could have done that you missed? But I'm more, let's look through the front mirror and let's look through the windshield, not the back mirror, and figure out, what's ahead for you. What are things that you can be doing now to be saving more in taxes? And that's our assessment engagement. There's a little testimonial there for those of you who can, who've got the slides to say that, how much the advisor enjoyed the assessment. So it's the main place where we start, because it gives you an opportunity to get to know us. And then also, to get an action plan and feel like you're going from a state of unknowing to knowing, so that you can take action and, get the results that you want. So those are the main ways that we engage, but I'd love to hear from you. Send me a LinkedIn on DM if you made it this far, and tell me your thoughts about the presentation, or other pieces or other things that you'd like to hear more about, or questions that you have, because it always gives me ideas for, future content for us to do. So appreciate you taking the time. Thanks for joining. And for those of you who listen to this via our podcast, this was a very special episode of the Financial Advisors Want to Know podcast. See you next time.